Hello friends, I am Gaurav Somani and today I am going to talk about one of the most important segments from the CFA Level 1 curriculum, time value of money. The importance of this segment could be seen in almost every segment into the CFA Level 1 curriculum, from FRA, quants, fixed income, portfolio, statistics to let's say derivatives, corporate finance. So almost everywhere you will see the utility of TVM concepts coming across. Let's try and understand this entire domain in depth a bit. So time value of money, let's say if I give you a situation where would you prefer $100 today or let's say $100 6 months down the line, an obvious reply comes that you would prefer it today because of maybe the inflation which is persisting, or maybe you can invest this $100 today somewhere which will give you something extra 6 months down the line. But then this is again a subjective situation. Inflation could be negative as well as the short term interest rate could be negative, like maybe in the case like Japan and other countries you have short term interest rates which are pretty negative. Or else if I give you this situation, let's say $100 today or 105 6 months down the line. Now the obvious reply which comes to us is it depends. It depends upon what? It depends upon the interest rate that you get. If let's say you're getting a 12% return and you're investing this 100 today, this would fetch you 106 after 6 months down the line, and you would prefer to have 100 today than 105 6 months down the line. If let's say somebody is getting an 8% return, that kind of stuff, this 100 would be worth 104 6 months down the line, and you would prefer let's say $105 after 6 months in this case. So what do we come to know about this is that if you have to compare distinct cash flows in different time frames, then we need to maybe go into the same time frame to compare them. So what is required out of someone is either to get the future value of this 100 after 6 months, how much of this $100 will be worth after 6 months, or maybe bring the 105 to the present value terms, say how much is required to be invested today to fetch 105 6 months down the line. And that's where the time value of money comes pretty handy in financial decisions. So if we talk about let's say any kind of a financial decision, if somebody is let's say investing around $4,000 today, expecting an inflow of let's say 1,500 for coming 4 years. So you have to compare whether you have to go along with that investment or not. What is required is either you bring or get the future value of this 4,000 for the coming 4 years, or bring this 1,500 to present value terms and say this is what it is worth in the present value terms. And that is where the concept of time value of money, any investment decision majorly requires an outflow today with expected inflows in times ahead, and time value of money lets you compare distinct cash flows in different time frame, because as the passage of time pass, the value of money changes majorly because of inflation and interest rates. So when you're looking upon the concepts of time value of money, let's try and understand this thing. There are two broader concepts which come into picture when it comes to interest rates. There is a simple interest thought which is principal into T, $1,000 invested let's say for 2 years at 10%. So after a year you get $100 in terms of return on that 1,000, and if you withdraw that kind of a return, then for the next year you again get that 10% on $1,000 only. So the cumulated value in that $1,000 comes out across to be around $1,200. The second case is of compound interest, where you tend to get returns on returns. So if $1,000 invested today gives you $100 after let's say an year, then your investment amount after an year would be 100 plus 1,000. So for the next year you would be getting a 10% return on this value, which will be 110, and the cumulative sum would be, let's say, 1210. The second case is of compound interest. So when you talk about simple interest, it's more or less P into R into T. For compound interest, you say that the future value is PV 1 plus R raised to the power N. Now, interest rate on a broader note are interpreted in three different ways: as required rate of return, as a discount rate, as an opportunity cost. When we talk about required rate of return, that is what maybe an investor seeks from investment. Whenever you think about bringing a future cash flow to present terms, we refer interest rate as discounting rates. And let's say when you determine your required return or something with a thought, what exactly you can get from the next best alternative. If I don't invest my money into an X alternative, I invest into a Y, the bare minimum that I could expect from that is more or less the opportunity cost kind of a thing. Among the three components, one of the most important from an investor per se is the required rate of return. And how does an investor go in terms of making his inference about required return is, initially basically you thought about getting, if I'm investing in any instrument, whether it's let's say equity, gold, real estate or anything, the bare minimum I can expect is got to be the risk-free return. And within the risk-free return domain, there are two concepts. One of them is with regard to the real risk-free return, and the other one is nominal. Obviously, the nominal covers the inflation component also from an investment. So let's say it this way: if let's say you are investing $100 today and fetching 102 6 months down the line without inflation into a risk-free instrument, this 2% is your real risk-free return. So if you have invested into US Treasury, there is no inflation, you're getting a 2% return, and we are referring to expected inflation, not the one which has already occurred. So if the expected inflation is 0 and there is no inflation in that duration, this 2% is basically a real risk-free return. But if there is an expectation of inflation of 5%, then from an investor per se, you would say, I would require additional $5 to cover my purchasing power loss. So $2 of real plus 5% of inflation, you expect at least a 7% return from your investment, and that's an approximate measure, not a precise, because you have given the impact of inflation on the principal only. On the other hand, you need to think about it. If without inflation after a year I'm getting 102, then I would require the inflation return component to be covering just not the principal but the return also. So basically what you need is, after 1 year down the line, is 102 into let's say 1.05, fetching you 107.1, or a 7.1% of nominal return. So the inflation impact has to be given on both the principal as well as the return component. And when it comes to making formulas, rather than let's say investing $100, if you think about investing $1, then in that case this equation will come down to, with the current example, 1.02 into 1.05, which is equals to 1.071, or to say so, 1 plus real into 1 plus inflation is equals to 1 plus the nominal rate of return. And that's the real risk-free or the nominal risk-free. We have yet talked about the risk-free return, but it's not necessary that you invest into an instrument which is risk-free only. So what are different types of risk that could be associated with your investment? So what we have talked about at this point in terms of determining the nominal risk-free rate, but from an investor per se, it is not necessary that you invest into a risk-free security only, and there could be variety of risk which could be associated with. For any category of risk that you bear as an investor, you seek an extra return. That's the broader thought. So if you talk about determining the required rate of return, it is basically, let's say, the nominal risk-free rate of return. If there is a persistent inflation, you would require a default risk premium. If you're not investing into a AAA rated government bond, or you're investing into XYZ company is equity or maybe debt or giving a loan to somebody, then you would require that default risk premium, that extra return for covering the probability that your principal could go down in terms of value when the return period comes across. You will require a liquidity risk premium if you are investing into a less liquid security to maybe, let's say, the US Treasury, which is the most liquid security. Let's say if you're investing into, let's say, a property or real estate, then it is not that easy to liquidate or convert it into cash on an immediate basis. Even if you do though that, you might have to get a discounted price also. Third, the maturity risk premium. The longer that time horizon that you invest, the risk is more. Let's say if I ask you about this thing, do you see any of IT company, or let's say any of an aviation company becoming bankrupt in another 6 months or 1 year down the line? You would say maybe no. But if I'll put the time duration, let's say 10 year, do you see that thing? The answer and obvious reply comes maybe. That is possible. So as the longer the time horizon of investment, the longer is the risk, and you would require an additional return to take that kind of a risk. And there could be other things also, like maybe if you're investing out of US, then it is a country risk premium or maybe a currency risk premium. So those kind of things could come in picture. So on a broader note, from an investor per se, how do an investor go about determining the required return? Risk becomes a thought in terms of expected return determination. You would prefer and will be very happy with maybe a risk-free rate of return if you're not taking any kind of a risk. And as any risk that you take, you keep on adding extra risk premium. So let's say that way, on a theoretical or conceptual basis, we can take risk as a basis to determine your required return. The other thing which is important from an interest rate perception is to understand that interest rates are always quoted on an annualized basis. Whether you invest for, let's say, 3 months or a 3-year horizon, the rate is always quoted on an annualized basis. To understand it, let's take maybe a small example. Let's say the annual rate is 10% and you're getting a compounding once in a year. So that's an annualized compounding kind of a thought. The effective annual return will always be 10% only. So from an investor perspective, you always look now what exactly I'll be getting after a year down the line. Let's say on the same 10% annual quoted rate, if you're getting semi-annual compounding, let's say you're getting returns on a semi-annual basis. So basically what is happening is, if you have invested $1,000, in 6 months you will get a 5% return on this, which is, let's say, 50. And if you don't withdraw this, then your accumulated fund is 1050, on which you will again get another 5% for the next 6 months. That will be 152.5, and the total fund that you would have accumulated would be $1102.5. So effectively, from an investor per se, you've not got the 10%, you've got 10.25% in terms of return. And as this compounding period goes lower within a year, the within a year compounding, let's say quarterly, then your effective annual return will increase more because you're getting interest on a regular basis. If you go monthly, this will further increase. If you go, let's say, weekly, this will further increase. So to determine this, how do you come across that effective annual rate? If you look upon to the formula to get the effective annual rate, it is said that it is 1 plus r by n to the power n minus 1, where r is the annual quoted rate, n is within a year compounding, maybe semi-annual or quarterly or so, and what we try to find out is on a given year horizon, how much is the effective annual return for an investor. Now when it comes to the effective annual return, the maximum or the smallest time duration, let's say, of compounding is you buy something and starts getting compounded. You start getting returns and the returns are compounding. So the time frame is into exponential terms, pretty small. To market like currencies which are working, let's say 24/7 and live market, you can purchase something at this point, and within the next fraction of second itself, you can sell it across. So the maximum return when we're looking down to in that case is, let's say, the effective annual return to talk about a continuously compounded quoted rate. If the quoted rate is getting compounding on a continuous basis, not on a discrete basis like maybe semi-annual, quarterly, monthly, if it is a continuous compounding, in that case we determine the effective annual rate as e to the power r minus 1, where r is basically, or the x here is denoting r, is the continuously compounded quoted rate, and that's your EAR. So let's go through with some quick examples on getting a better understanding on the TAVM concepts. So if let's say an Indian bank offers an interest rate of 6% per year compounded annually, and how much will you have at the end of 8 years given the amount invested is in the scheme is rupees, let's say 50,000 odd. So if you look upon to this is how the calculations will be moving. Like 50,000, you need to get the future value, which is PV1 plus RS to the power n. You can do this thing with your financial calci, put your PV as 50,000, your n would be, in this case, will be 5 years. The rate which R is denoting to the slide would be 1 by Y. So I by Y in your calci would be 6. You need not to put 6%, just press 6 and then compute the future value, and you'll get your answer over there. Let's get to maybe another question. A bank offers again an interest rate of 9% per year compounded annually. How much will you have at the end of 10 years given the amount invested in the scheme is rupees 50,000 at the end of 5th year? So here we are making an investment after 5th year, and we would like to know the value 10 year down the line. So if you look upon to this into the timeline, basically the future value will be 50,001 plus the rate to the power 5 only. But then when you doing it with your calci again, put your n as 5, IY 9, PV as 50,000, compute future value. Obviously you would see that value in a negative with a negative sign, but ignore the sign. The calci works with an inflow and outflow mechanism. 50,000 you getting, so you might be giving it back, or if you put your present value negative, the future value will come positive. So the sum that you get is 76931.2. and if in the same question, let's say it asks you to invest or get the value after 15 years from today, so the investment duration would be 10 years. In that case, all you need to do is just change your n as 10 and compute FV. So this will come as 118368.18. So to get the present values and futures values of a single lump sum. So let's take another example wherein you are required to find out the present value of a lump sum amount to be received, let's say 5 years down the line. So at a rate of, let's say 9 odd percent, 5 years down the line, let's say 50 odd thousand. So how you go about it is you have to determine the PV. In your financial calculations, now your inputs will be FV will be 50,000, N will be 5, IY will be 9, and you have to compute the PV, which will come to 32496.57. Let's take maybe till this time we have talked about examples on present value and future value of lump sum cash flows, maybe at starting from, let's say, today or after a period of time also. Let's talk about maybe investing on a regular basis. If you wish to invest on a regular basis, or if you wish to withdraw on a regular basis, so it's like 50,000 invested for 5 years, every year, end of the year for coming 5 years. What will be the future value that you'll get? Or maybe you want to receive 5,000 starting from today for another 5 years. So, or let's say another 4 or 5 years. What is the present value which is required to be invested somewhere so that you can get this kind of a cash flow? Till this time we have talked about cash flows with regard to lump sum amounts, determining the present value and future value at any point of time of a lump sum amount of cash flow. Now if you tend to invest on a regular basis into an instrument, let's say $5,000 every year for another 5 or 10 years, you want to know what will be the future value after 10 years. Or else, let's say somebody who want to retire and for another 15 years they would like to withdraw from their retirement corpus or maybe the pension fund equal sum on a regular basis, we are referring to an annuity stream, an annuity of equal amounts. So let's see and try and find out what are different types of annuities that we have. So there are broadly two types of annuity streams. There is an annuity ordinary mode, wherein you get the amounts at the end of the period, or you deposit at end of the period. Let's say if you wish to start depositing regularly $50,000 after 1 year, so that's kind of for another 10 years, so that's an ordinary annuity. Or you intend to do that from today itself, 50,000 I'll start today and I'll make another 9 payments, so total 10 payments of 50,000 on a regular interval of 1 year. This will be an annuity due mode, an immediate annuity, what you call as. So let's look upon to determining the present value of an immediate or annuity due in terms of a question. So a bank offers interest rate of 9% per year compounded annually. An investor wants $5,000 at equal space interval of 1 year for the next 5 years. Payment happens at the start of the year. So this is kind of an annuity due. What is the present value of this annuity? If you look down to this, your calculation would be like the 5,000 that you will be getting today will be discounted with 0 year. 1 year down the line will be getting discounted by 1. So your N is 1 and the IY or the rate is 9%. And successively you bring the present value of all the different cash flows and sum it across and determine the total. Now that is where the BA2 plus Calc becomes very handy for the exam preparation. This calculations can be done very easily using the BA2 plus professional Calc. Just put that 5,000 as the PMT, the annuity figure as your PMT, N is 5, IY is 9. Now we need to understand this thing by default. If you now go down to calculate the PEV, the problem would be by default the BA2 plus professional Calc is set on ordinary annuity mode. You have to change its setting from ordinary annuity to a beginning annuity or an immediate annuity. That instructions are given into the video that we have made for you for the utility part of the BA2 plus professional Calc. Just set your Calc on the beginning mode, calculate PV, that will be the present value required to receive this 5,000 sum for coming 5 years on a beginning annuity mode. And if you have to do it for, let's say, ordinary annuity, just reset your Calc from beginning to ordinary and compute PV. For this kind of question, if you want to find out the FV also, all you require to is put your inputs in N, IY, rate, that is the PMT, PV if there is any, and compute FV. Do remember the signs are pretty important. Inflows and outflows have to be taken into consideration. Let's take another set of annuity stream. We have talked about a finite segment of annuity stream this point of time, 5 year, 10 year that you would like to withdraw. But at times annuity streams are for an infinite. You wish to get something on a perpetual basis. Now let's look upon to a perpetual annuity stream question. Till time we have talked about a finite or a discrete time period annuities. If you're looking down to get something in terms of a sum for a continuous basis, for an perpetual basis rather than, then we're looking at a perpetual annuity stream. How do you go in terms of solving what amount is required to be invested today to get a perpetual annuity kind of a stream. So let's go through with an example. A bank offers an interest rate of 9% per year compounded annually. Mr. A wants to receive $5,000 at equal space interval of 1 year till perpetuity. How much would he invest today? That is specifically nothing but the amount divided by the interest rate, which will come down to as the 55,555.56 dollars. That's the amount of investment required today to get a perpetual annuity stream. So two things very important to get the present value of a perpetuality. It is amount divided by rate. Let us just take one last example on the TVM part. For a given loan of rupees 2 lakh, what will be the equated monthly installment given an interest rate of 9% per year? Tenure of the loan is 5 years. So here we are required to find out, let's say, the EMI of the loan, which is effectively a regular payment, the PMT component. If the compounding is annual, now the important part is, if the compounding is annual and you have to find out the EMI on a monthly basis, then the quoted rate, which is 9%, is effectively the effective rate of return, and from this effective we need to go down to the nominal rate. Now, one of the way to calculate the effective rate of return we have gone through into the earlier slides or earlier portion of the video with the formula. Let's do it with the Kelsey directly. So to calculate the effective rate of return from Kelsey, you can use the I convert function, put the effective rate as 9, C by Y over there will now be 12, and compute for the nominal rate. Now that nominal rate divided by 12 will be your I by Y into the rate. Put the remaining inputs as PV as 2 lakh, future value as 0, N would be 60 because this is monthly compounding, and compute for the PMT, which will come down as 4117.66. The second thought is, if the compounding is monthly, if this compounding is monthly with 9%, then this 9% is your nominal rate. You need to just divide this 9% by 12. So your I by Y in this case will come down to 0.75. Put this as your I by Y into the Kelsey, N60, PV, 2 lakh, and compute for the PMT, which will come as 4151.67. So the important thing is, you need to understand the rate given in the question, is this the annual rate or effective rate? We have discussed the difference between the two earlier also. Thank you so much.